Onto your markets news now. Asian shares were broadly on the up on the back of US Fed minutes from November, signaling that a majority of monetary policy makers are of the view that a slowdown in interest rates may soon be appropriate. In Japan, data showed that manufacturing activity had contracted at the fastest pace in 2 years in November. Despite that, the Nikkei share average closed up 0.95%. Hong Kong stocks were also firmer on the day, with the Hang Seng Index ending 0.78% in the positive. On mainland China, a surge in COVID-19 infections continued to preoccupy authorities there, with concerns around how this will affect that economy. The Shanghai Composite Index declined by 0.25%. Over in the United States, Wall Street's main indexes ended Wednesday with solid gains after the Federal Reserve's November meeting minutes showed interest rate hikes may slow soon. The S&P 500 gained 0.59%. The Nasdaq Composite gained 0.99%. Let's just call that 1%. The Dow Jones Industrial Average rose by 0.28%. Trading volume was thin ahead of the Thanksgiving holiday on Thursday, with the U.S. stock market open for a half session on Friday. On the local front, the JSE is taking its cue from global markets trading higher. The all-share index is 0.7% firmer at 73,383 points. The industrial 25 index has added 0.8%, financials 0.1% firmer. Markets in Europe are in positive territory. Britain's FTSE 100 is up 0.2%. The CAC 40 in France is 0.7% higher, and Germany's DAX has climbed 0.9%. Looking at commodities, gold is trading at around $1,756 and $998 per ounce, while the price of Brent crude oil is now at around $84.75 a barrel. The rand is trading at 17.01 to the dollar, 20.61 to the pound, and 17.71 against the euro. Well, to discuss how the markets are faring and why, I'm joined by Viv Govinda. He's a portfolio manager at Rand Swiss. Thanks very much, Viv, for joining us. So markets appear to be in good spirits following the release of those November minutes. Are you cautiously optimistic about their slowing the rate cycle, or do you think perhaps the market may have read too much into it, because no doubt there were other cautionary statements made by the Fed?
Yes, I think the market may be taking a bit too much comfort from it, but I mean, that's to be expected. We did expect a bounce up of the 3,500 level of the S&P 100. Basically, a number of factors out there. We are seeing U.S. housing prices fall. The way they measure it especially is being affected by the fall that's coming through. We are seeing medical insurance, which is another big, it's not a bit of cost of inflation, but a big factor for their inflation number also come under pressure. But to a certain extent, this is a local U.S. phenomenon. We've seen UK inflation, for instance, come out recently that's higher than expected. We saw our inflation number come out recently higher than expected. And so even though we are seeing a bit of pullback from the US in terms of its inflation numbers, it's not a global phenomenon. It's primarily restricted to the US at the moment.
We'll touch on our local Reserve Bank interest rate hike in a second, but with the dollar now weakening, given the fact that the market seemed to be excited about the prospect of slowing rates and there being a sell-off in the US dollar, what is this doing to commodities? How's that translating?
Well, as you saw, the oil price has been incredibly volatile. A few days ago, we basically went all the way down to 83, then bounced back to 89, and now, as you mentioned, back to about 84. The oil price has been particularly volatile, recently. We have seen gold prices bounce off the low as well, just above the 1,600 level, slightly down today, but after a very substantial, jump up, after we had those inflation numbers coming through. So the market's getting a little more pushed today upwards, but generally much of the improvement happened after we had those good inflation numbers from the US a few weeks back, and that was really what drove the market higher. So we're adding a little today, but the market was expecting, this coming through.
So when it comes to our local situation, what's the market expecting around interest rates, and to what extent do you think the Reserve Bank may be influenced by this narrative now that there could be a possibility of slowing interest rates elsewhere?
Well, I don't think they should be influenced by it, quite frankly. Our inflation number, like I said, came in a bit higher than expected. So South African inflation is higher than expected. and likely to get worse going forward. I think we are expecting a petrol price hike in December, sorry, if I'm not mistaken. So we are likely to see, more inflationary pressures in South Africa. So I don't think they should be basically doing too much. The expectations are probably between 5.5 and 0.75. And I think 0.75 is by far the majority consensus number. A couple out there are saying 1% perhaps, especially after that inflation number came through. But I think that's, overdoing it. So I'd be expecting, 0.75 and not 0.75. A smaller chance of 1.5.
Viv, of course, a couple of retail results came out today. We saw Mr. Price as well as the Lewis Group coming out with their results. Just give us an overview of your view on those stocks and also how you feel about being invested in the retail sector right now. Should we be going in right now or pulling out and so on?
Probably not. Mr. Price talks about the fact that they're a lower cost retailer. We talk about the fact that load shedding cost them tons of hours across the stores, so 3,000 hours across all the various stores and so on, as well as the fact that even payments for social grants have been not as consistent as they should have been, and that's obviously affected them as well. Lewis mentioned the fact that they are seeing consumers still buying, but buying on credit a lot. Their cash outlets are already being punished. All this indicates to me that the consumer is under pressure, and even though they haven't basically really pulled back dramatically at the moment, purchasing on credit and so on, over the next year or so, we do expect there to be not just a South African but probably a global recession as well, driven by these interest rates, high oil prices, and all the other uncertainties happening in the world. And you really don't want to be exposed to retail when there is a recession happening, because that's really going to be one of the factors that really is affected by the country's GDP.
Indeed. But just on that point about your exposure, if you're already in, do you withdraw, especially if you've made a loss, or do you just stay in there and hope for a better day, say in the next 2 to 3 years?
Look, we are still going to be buying stuff, 20 years from now, 100 years from now. That's just the way it works. However, I think there is a point of disruption happening in retail at the moment, so you don't know who the winners and losers are going to be in the future. Look at the US, we've had stores that have been around for 100 years, disappear because of the online and so on coming through. Greater power. In terms of clothing retailers and probably furniture as well, I think maybe there might be less ability for that to really take it up. People want to see and want to feel what they're buying. But I think that retail is really due for a disruption, and even if you take a loss, I think you can't really look at what your sunk costs are when it comes to investing. You want to be looking at what the future growth prospects are. And right now, I would be very nervous about the retail, as you can see, because of load shedding.
Yeah, no, absolutely. Viv, thank you very much. Always great to have your insights. Viv Govinda is a portfolio manager at Rand Swiss. We're going to take a quick break.